guys, welcome back to the Capital Mindset Show. We got a special guest with us today. This is actually a subscriber. His name's Arturo. And just so everyone understands, before we begin, I'm not going to do this a lot. This is actually because Arturo is the first subscriber to ask. And you want to talk about, how it is you came onto the show?
Yeah. Well, actually, so I started watching a few of your videos, Fabio, and I'm very interested in the market, and I know you have a lot of smart stuff to say. And I was like, let me just give it a shot. There's nothing for me to lose. And just added you on Instagram and was like, hey, I have a few questions. I want to add value to you too with this conversation. If you want to record it, let's do it. I'm 100% sure some other people have the same questions as I do and would like to know.
Yeah, of course. And of course, Arturo and I, we spoke already a little bit before this, and we got to know each other a little bit. We had very interesting conversation. I'll tell you that right now, Arturo. And on that note, there's a lot of questions. Again, the way it's going to work is Arturo can ask me pretty much anything. And maybe a lot of you out there have similar questions that hopefully can be addressed here. Again, this is going to be a rare occurrence because unfortunately I don't have the infinite time. I wish I could talk to everyone and get to know everyone on a deeper level. But it will be kind of on if I can basis. But Arturo, have at it. You can ask anything you want.
All right. So question. All right. My main concern for you is your job. Because I know you said on the Strawman personal finance channel in the podcast, you said that you work, if I'm not mistaken, correct me if I'm wrong, that you had that you work for this company. They make excess amount of money and you're in charge of investing them for them, getting a different kind of profit for them. Can you tell me how it was that you got there? What's your education? Let's say that I wanted to be in your shoes. What would I have to do or something similar to be like you?
Okay. Well, I'll start with one. I don't have the absolute level of authority or responsibility that I'm in charge. I'm not like the CIO, but I do contribute. It's a small team though, because it is a small company. And one thing I'll say for the first part, well, in terms of size, I'd say if I had to say large, medium, or small, large being, a multi-billion-dollar firm, it's a medium-sized business. It's owned by and operated by a family. So a lot of the decisions are, very quick, not much bureaucracy. And so I just wanted to clarify it. I don't have absolute responsibility. It's not like, oh, we're going to invest in this. It's only my decision. That would be very interesting. But with regarding to how I got there, again, since it's not a family run at this point at the current size that it is, but it's controlled by a few individuals. It's a private company, again, with very little bureaucracy. What ends up happening in those instances is, I guess I can speak to this in general. The smaller the company, it is a higher risk, higher reward. You do get more responsibility than you would at a larger firm. So let's say an equivalent of this sort of business, if I had to say, is something like let's go with the extreme, the absolute extreme. Something like a Brookfield Asset Management, but not like that at all. Okay, because Brookfield, they specialize in that. This business specializes in its core business and then has this on the side where then it basically, again, invests excess cash flows into any form of investment, whether it's private deals, public companies, real estate, stuff like that. Okay, and then to answer your question, and by the way, this is a rule, Arturo, you can ask the question again if I do not answer it, because I'm not a politician.
Yeah,
and I want you to hold me accountable to that. So ask it again.
So yes, okay.
Sometimes I ramble, but
I mean, no, that's good. One thing that I wanted to answer specifically, just for people like me.
Yeah.
What background do you have?
Yes.
That because I imagine that they didn't just pick out a random employee. It was like, hey, you're in charge.
No.
So what is that you have?
So I have a background in education-wise. I have a background in both accounting and finance. So I graduated with 2 degrees in both those both those majors, right? And what I did with that is over time, when I was in college, I dedicated myself to really going above and beyond the classes. I did actually an internship for this company. And then they got to know me on a different level. And I also got to know them from a different level because they, one of the connections I made, and this is actually a good part about life itself. Life is about, meeting people, getting to know people themselves, and you never know what relationships can come of that. But I had a tutoring business while I was in college. I taught kids of different ages. I didn't go as young as middle school. I had some. And for me, I stuck with high school and IB. For those of you who don't know, that's International Baccalaureate program, AP classes, and then college classes. I had one kid that was doing an MBA. And then what I would do there is he would hand me the material. He was a baseball player, so he had no time, and he would hand me the material. I would learn the material ahead of time, then teach it to him. And he was a client for a long time. So he's pretty crazy because I don't know how he has time for everything. But regarding that, among that time frame, I got to know a lot of different people, and then through that, I met people in interesting career paths, and then kind of met the right people, I guess, and then they gave me a shot. Okay, because they knew my temperament. They knew that I would work hard if they gave me a task, and they would take a chance on a younger guy. And from there, I learned in that industry with a good amount of people who were already doing that for a living. And now I am where I am now. So basically, to kind of summarize it all, education in finance and accounting, and then how do you get to these kinds of positions? I mean, the standard one when people think of is they think they go to hedge fund, or they go to something in like the big four accounting firms, or regional firms. But there's so many different options. Life is like, there's incredible amount of opportunity out there. Sometimes the unconventional ones are the best ones. And regarding, I mean, did I cover? I think I covered everything.
No, you're good. You're good.
Okay.
So now let me ask you this. What is your day-to-day? Because I know, okay, let me put it to you this way, right? I know a lot of us, see some charts, see PE ratio, this and that, and we're like, oh, stock market is amazing, this and that. Talk to me, what's the real, 9 to 5, what's actually that you do? Because I imagine you're not just there, speculating, thinking about, this, that, you don't see, you don't see technical analysis, none of that kind of stuff. I imagine you actually sit down, do your actual work. What is work? Describe it to me, please.
So publicly traded equities is the quickest ones, okay, if I'm being honest. And that one is basically done so in a discussion format. Most of the time is not dedicated to those. Most of the time is dedicated to private entities. So, that can constitute of, getting the financial data from the current owners that are looking to sell the business, right? And then it's breaking down those documents that are often, GAAP is really nice. GAAP is, for publicly traded entities under the SEC filings, that's all well and good. But sometimes when you get these private businesses, it's not organized so nicely. So you actually have to parcel through. That takes a lot of time. And the other is perhaps, well, it's still kind of in the same category because it's still private. It's real estate. So real estate itself, if it's commercial or industrial, and in this case, we were focusing more recently on industrial, like warehouses and stuff like that. That can take some time because, again, you have to parcel through it, come up with a valuation, and then kind of present the idea after, we all kind of agree on it. And then we get the green light, we go meet with the people, we put the offer, negotiation back and forth. So I'll participate here and there on that side, but that's more delegated to someone else. But for the most part, from the day to day, it's not a 9 to 5. It's kind of a 9 to whenever, or sometimes it's a 10, sometimes it's an 11 to whenever. It just entirely depends on, okay, are we going to go meet with the current owners of the business? If so, yes. What time are they available? What time does the boss want to meet, right? Because the boss, this is, again, low bureaucratic, which I do like. It's not like a big mega corporation where everything is on that time. It's basically on when the boss says, okay, guys, I need this by this time. I want to meet at this time. Can you guys do it? Yes, let's go. Stuff like that. That's kind of it's not a 9 to 5, but I know what you meant by the question. And if it is also not a Monday through Friday. Oh my gosh, no, it could be Monday through Sunday sometimes. It depends.
Okay. question. Let's say that you wanted to replicate what you're doing, right? How would you do it?
Like do it all over again?
Yes.
Okay, so because the thing with there's no standardization process, which actually makes the question difficult to answer, but I will attempt to answer it in slightly different way. So slight caveat to it. But let's say you wanted to get into the investing world. There's many different ways of doing it. I know of one direct way is actually through getting experience at a Big Four firm. It's a very, I'd say it's a very, not direct way, but I think it's almost one of the surer ways is getting experience in these firms in the form of auditing department, but then showcasing, because technically in investing, you don't have to have some sort of credential. It's not about that. They do a lot of mindset interviews, right? So if you go to a hedge fund interview, they'll ask you some interesting questions. The reason why they're doing that is to kind of parcel through the candidates to see how they think, right? And the reason why I'm mentioning kind of like this direct way through is it's kind of like if you want to gain some sort of technical experience, and let's say that's in looking and designing and parceling through financial statements, then you want to work on saying, do I have the mindset for this that would be attractive to these businesses? Because they'll look and say, okay, that's impressive. You have that experience, you're a CPA, but at the end of the day, they're going to want individuals with a particular mindset to kind of think outside the box. And then if you have that experience, that does help a lot. For example, I know that there's an investment bank, it's a boutique investment bank, Houlihan Lokey. Most people don't know that even exists, but they're pretty decently sized. Last time I checked, I think their market cap is in the several billions, if not tens of billions. But they say so in their applications that, okay, we really like Big Four experience, particularly in audit, right? Well, why do they say that? Well, if you're going to be an investment banker, it is a good skill to have with regarding to how do we create or formulate and make sure financial statements are correct. It's a good experience to have that you have done that in the past. Is it vital? No, they don't say required in the application. They'll say preferred, right? Or preference on that. But even then, you know, you could go into college, study finance, and if you have the mindset or you have someone to vouch for you, you can get into a hedge fund, absolutely, right off the bat. But I'm kind of saying that in a more broad scope, what was one way of getting there. As far as replicating exactly what I've done, that's difficult because these are smaller entities that are more personal, right? They are more personal. It's not like you just simply apply and they're always taking applicants or anything like that. It's kind of like the position is open, the person is looking, you're kind of there and they like you, they see how you work, they'll give you a shot, you prove yourself, they hire you, kind of deal. There's going to be a bunch of companies like that out there, by the way. It's just everyone's going to have a unique and different experience when it comes to that.
Yeah, obviously. Also, because you kind of said this in a way, tell me if I understood it the correct way. You said that there's more to the job than just looking at funny charts and that, you know, oh, this a meme, this and that. You get me? It's more than that. And you're going to have to put in some effort to do it. It's not just easy as anybody can do it. Well, anybody can do it if you put in the effort, obviously. And the most important thing is mindset.
Absolutely. Capital mindset.
I think, yeah, I was there. You stole that from me. I was gonna say it. But yeah, question now for you, right? Because, you know, last year a lot of people got some bubbly stocks. You know, we heard, you know, a lot of stuff about some stocks, especially about unprofitable stocks, right? How would you invest in unprofitable companies?
Okay, so an unprofitable business, let me ask you some questions because I need to know specifically what kinds. Is this an unprofitable business that we have proven that it can scale? Because there's two types of unprofitable businesses. There's profitable businesses that will not scale or are showing that they're going in the opposite direction of scaling. One example, I'll name a company right now, is Context Logic, otherwise known as wish.com. I'm going to do a video eventually as like a case study as to how it's a company that was going the opposite direction in terms of scaling, right? Because there are some businesses that are unprofitable today, but we can see that they are scaling, right? So let's assume, I'm assuming we're saying it is a company that's not profitable right now, but we can see that it is scaling, right? So if that's the case, okay, then it depends on one, what is your confidence level in terms of how much will it scale? Two, are you being honest with yourself in terms of your confidence level, which is actually more important than your confidence level, right? You can be very confident. You'll be like, oh yeah, that's going to be profitable. I'm super confident.
10x.
It's going to 10x. But you know, you're lying to yourself. You're kind of telling yourself, hey, Fabio, you're really confident about this, even though you're really not, but you're telling yourself, you're like, and you're creating almost like an echo chamber within yourself. And you're also finding other people and you're putting yourself into an external echo chamber. So that won't be good. But let's say you think you are confident in it, check. And you're not lying to yourself that you actually are confident, check. Okay. Then comes the case of worry about more what happens if you're wrong than if you're right. Okay. And then this is where people like to quote Buffett, but then they don't apply Buffett. Buffett's famous rule quote, you know, rule number one, don't lose money. Rule number two, don't forget rule number one, right? Okay. They say it, they quote it, but what does it really mean? Well, what it really means, what he's trying to tell you is it's more important to focus on capital preservation than capital gains, right? You work really hard for your money, right? Why are you in such a rush to lose it? You know, we want to make sure that we keep what we have, and then it growing, our money growing will come with it. If we pick great businesses, that will come with it. But the number one thing we should worry about is what happens if we're wrong. And then that goes to kind of, if I'm echoing back our conversation in private, a little bit about, you know, us being humble, right? We are not always going to be right. So then if we just try to plan around those moments where we're going to be wrong, that will better suit us. And especially with a business that's not profitable, because when a business is not profitable, let's say, and let me define that very clearly for everyone. When I say not profitable, I'm talking about companies that are cash flow negative. Okay. Not the ones that are cash flow positive, but on a GAAP basis, they're not making money. I want to distinguish the two. A company that quite literally is burning more cash than it's bringing in. Okay. Those are, and I'm picking that one because it's the hardest one to really think about.
Question for you. Do you think, and I know there's a lot of bad apples out there.
Yeah.
Do you think that companies that are unprofitable, let's say they're having high revenue growth, right? Just give an example. Do you think that at that point, somebody will be considered more of a VC than an actual investor? And maybe could, because let's say, you know, I know, let me just give an example of Tesla, right? Because I know Tesla is overvalued, but let's go back a little bit, right? Tesla, 2015, still unprofitable. It's been in the market for some time, right? Usually, at least from my experience, what I understand is that companies who like to go on the unprofitable stage in private, have some VCs, that kind of stuff. And then once they're profitable, but they're kind of slowing down in growth, they will then go into the stock market. They will then go into the market. And then you can attract investors, get more money, that kind of way. Do you then suggest that maybe somebody, and now I don't want to push the idea of you're going to 10x, 100x. That's not what I'm saying. But could somebody play in the smart way, and instead of an investor, think of it more, well, an investor is a VC, but let's say somebody becomes more of a VC and, you know, capitalizes on a company being unprofitable, right? They have some high hopes. They see that they still have some good management. So I think that's very important. I think that you can have an idea, but if you have bad execution, worth nothing. You know, you believe in the management, you see their background, and then the company, you know, it's unprofitable for sometimes, you know, it keeps going down, it goes down, but then you see that it's growing. That could be in revenue, that could be in asset, whatever. Would that be a smart idea for somebody if they keep it to a very small amount of their portfolio?
You just answer the question with that last part. And it's not has to be small. It has to be I'll say this because everyone's different for their own specific scenario, a responsible amount. So go into venture capital. Let's say, who are the typical investors in venture capital funds? typically very wealthy people.
Mm-hmm.
Are the very wealthy people, are they putting a portion of their money, half of their money, all of their money? The answer is typically it's a small smidget of it, right?
Mm-hmm.
Because like I think of it, not I think of it, this is kind of the mathematics behind it. Let's say you really think this is a 100x company, hypothetically, okay? And you put 1% of your portfolio in that 100x company. If it goes to zero, that 1%, it's a day-to-day move. It could be a day-to-day move, right? But if it does 100x, are you not going to feel that? You are going to feel that. You're going to be wealthier for that, okay? But it's all about, so it's getting back to that principle, it's managing risk, right? Managing risk is a skill, and it's a very important skill for all investors to understand. So that's basically why other creators, for example, and I'll say names like Strongman Personal Finance, why does he espouse VT? Well, VT as an investment is a capital preservation tool. If you listen to some of the things he's trying to say to the audience, and again, he'll probably comment down below if I'm misrepresenting here, but what he's trying to say, and this is from his perspective as a CPA and all that, the VT is main goal is for you to focus on generating more money and putting it, and it's almost like a savings account, but it's a savings account that would grow and generate not income, but wealth with at least inflation, if not a little bit more, in line with the world economy, as the world economy grows, et cetera. So it takes away a lot of effort necessary or needed to pick companies, right? Will you do the best? No. But for most people, that's fair game, right? Because the goal is capital preservation. Then again, you get to position sizing. Let's say you don't want to do that route and you want to be a picker of companies. You want to pick individual stocks and you think that that's your route, that's good for you. Then capital allocation is vital. If you allocate too much and you're quote unquote too confident in something, but you weren't really that or not that you were confident, but you really didn't know, right? You didn't really address all the risks. Then you're going to find yourself in a bad situation where, you knew that it was going to 10x or 100x, but you put 50% of your portfolio because you calculated that if you put 50% of your portfolio, you would be a millionaire if it had 100x, right? But that would be technically the mistake, right? Because even then, it's going back to a little bit of a concept, like a little bit yes, a little bit no, that you're being a little bit too greedy in that sense. And I use the word lightly because it's not really greed per se, because it's not like you're taking from someone else, but you're hurting yourself. You're the only one you're hurting is yourself in that situation. But would you really suffer if you put 1% of your portfolio and it did 100x? Would you complain? Now, why is that example very important? It's because look at the focus, and that's echoing back to Buffett. The focus is on capital preservation. Don't lose money. Okay. And I think, like, for example, I do that with my speculative stocks, right? I have a rule for myself, but everyone will have their own rule. I only put a maximum of 10% into the speculative stocks. And I try to be as honest as I possibly can be with myself. What is a speculative stock? There are some in there that are not profitable. So
right, my question is for you now. Let's say, all right, so because I know in YouTube especially, we hear I put $100,000, $1 million, $500,000 into this stock. We don't know what's actual net worth of this individual. So then we're comparing that amount to us. So I feel like sometimes we're like, oh, I have to go 100% in. And then also the videos of going all in, blah, 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 doesn't really help out. Kind of more of like, I just love how, especially for saving money, a lot of people are like, let me follow the rich. They don't spend a lot of money. But now in investing, we don't really kind of go that route. It's 100, I'm going to go 100% in. So now I'm going to 100x. Yeah, like a VC, like you said right now, right? They will only allocate 1% of the money because they know it's risky. Example, I believe, and tell me if my thought is correct. One of the most important things to do is raise your income. Raise your income. And then second after that, well, depends also what kind of income you have. But let's say you are low middle class, high poor class. You would, I think at that point it's more of increase your income, and then kind of see where you're spending and allocating your money, and then just another thing will also be understand what you're doing. You get me? It's funny how for jobs you have training. Some jobs they give you especially intensive amount of training. Yeah, when we going to buy stock, we're like, oh, I like the name, I like the story, I'm going all in. I don't know what a PE ratio is. I don't know what kind of cash they have in hand or how they're spending it. But yeah, we're gonna go all in. You know, it's funny how, especially how I like your channel because you do that. You go into numbers, but you also go into mindset,
Yes.
capital mindset.
Capital mindset.
Had to sneak it in there.
Yeah.
But yeah, I like that. I like that a lot about the whole, VC that they only allocate 1% of the money. And
Allocation.
it's true. It's true. Yeah.
It's also, if you noticed, I have the portfolio public, but what is missing from that? And it's actually touching upon that exact thing you just said, because the goal of this channel is strictly to impact, and I've responded to this in comments below, so I know it can be repetitive, but impact people in a positive manner in their investing journey. So if you look at the public portfolio, it has what matters, which is allocation, percentage, and then people can be transparent and judge performance, right? What it's missing is the dollar amount, because it does exactly what you just touched upon that I haven't really touched upon yet. It can negatively influence someone by saying, it's exactly why I don't make a video saying going 500,000 into this stock, because it drives that mentality that is exactly what I'm not trying to do for the audience. That would be a disservice to my audience, because it will drive an emotional side of investing. It will get a lot of clicks. I already thought about it. I had this discussion with my ex-co-host who used to be on the show. We used to have the discussion, should we put the number out there, because perhaps it would draw more audience attention. I thought, no, we're going to grow organically, and we're going to just get the ideas out there, because if we show size positions, we're buying this much, it draws that wrong sentiment that I don't want to kind of gather an audience around that. I want to make people kind of like the video for its ideas and strictly that, and then think for themselves, is that a good investment for me? I could be buying something, and then for you just don't like the company, and that's perfectly fine. But if, for example, if you do that, like, oh, I'm putting $1 million into the stock, you're gonna be like, well, he's putting $1 million in the stock. I have a $10,000 portfolio. He's super confident. I'm gonna put all $10,000 into that stock. That mindset is not something I want to develop.
I kind of want to talk to you a little bit about that. Also, I love how, going a little bit to what we talked about privately, I love how, everybody in their own personal life usually, well, I'm going to hustle. I'm going to do more than the person next to me, right? But yeah, there's this culture, and especially in the YouTube finance, right? Where it's like, oh, this guy is going on it. I'm going to do exactly what he's doing. Yeah. The whole model in Instagram and Twitter and, talking to everybody is, oh, I'm hustling more than you. I'm doing more than you. Yeah. I'm hustling because I want money, right? That's the whole point, I believe, of hustling and getting obviously a better life, not just money. Yeah, I find it funny how, I'm going to do more than you, but then to invest it, oh, this guy said this stock. Oh, let me go over here. Oh, and this one said this over here. I think it's more important of actually, and I know, it gets a little bit repetitive, learning what you're doing. Learning what you're doing. I always find it funny how nobody, at least some big financial YouTubers, they don't make their course like into a YouTube playlist. I would imagine just by views, you will get more money that way. And you're still doing, you won't?
No. So let's say if I could, I'm making a course, right?
I heard about it. Yes.
The course will be pay what you want. That's the key distinction. Pay what you want.
Okay. I like that.
We can talk about it. But for the most part, it actually will be a YouTube playlist. I've decided, because I thought I checked out Udemy, and I'll have this discussion with you, because when I'm talking to you, I'm talking to everyone else out there who's watching. So and you give me your thoughts as a subscriber. I want to hear your thoughts. I was thinking about Udemy and Teachable and all these, but the problem with that is if I went with them and I said, it's free, right? Because I still want to keep them out. They limit me to 2 hours, and I want to do 3 separate courses: personal finance, like as if college finance, and accounting, like college accounting. And that will be, again, to whoever wants to take it. I'm going to have like, questions, assignments and stuff. I'm going to put the answers in there like as a separate file, and I'm going to trust people not to cheat because they want to learn. But for the most part, if I had done that with these services, they would have limited me to 2 hours, and I can't do a quality lesson.
Can't condense it.
Exactly. That's not going to be a good one. So I'm just going to do a YouTube playlist. It's going to be very simple, and it's going to be literally ad supported. And if someone wanted to, they can, I guess, pay or not pay. But the point is, the information is going to be there. And again, to fit the goal, because again, it kind of matches the end goal of the channel, which is, which we already discussed. I won't repeat that. But with that being said, like, let's say, you have advertising revenue. People think YouTube advertising revenue is a lot. It's not really. Okay. It like this channel, for example, is mostly like a labor of love, if we're being honest, and it will be for the foreseeable future. I don't foresee a moment where it replaces my main income. It's probably not going to happen. And if you say a course, right? Let's say someone pays me, let's make up a number. You tell me a number. How much would you pay? How much would someone pay for an average course?
$1,000.
$1,000. Okay. So do you know how many years it would probably take for one YouTuber viewer to generate me $1,000 in ad revenue? I don't know if they'd even live long enough. Just watching the videos over and over and over again. So yeah, it could get, like, let's say it gets 1 million views, right? If it gets 1 million views, let's say hypothetically it generates $20,000 for 1 million views. And I'm saying in total for a course, in total. I could generate that with $1,000 selling it 20 times.
Yeah.
And then I can sell it 21 times and I'm already above the $20,000, right? Now, hypothetically, if you sold 1 million, you see the staggering difference between that. So YouTube is good in the sense of you can get exposure, but you see a lot of these YouTubers, they build a business on top of it, but you can see that they want to make money through the course. That's how they're trying to make money. YouTube finance is centered around the course model.
Yes.
So,
I mean, well, appreciate you for answering that question. I don't know. I feel like, just again, capitalist society, right? I just feel like, back in the days, at least I remember, cell phone lines used to be by the minute. You got me? Then somebody decided to do a contract, and then somebody decided to do unlimited, right? I feel like at some point, it's just somebody, right, willing to take the cut, but just for volume. Maybe just doesn't work out in this scenario. It's like for YouTube. But I just imagine that it'll be just a better idea, and people will just prefer it this way. Why go buy it from this person when I'm not even gonna get probably personalized time, and it's probably just some videos, because it's literally like a lot of courses just literally just videos. You get me? Why not do it on YouTube? It's literally you're still getting you're still just getting the video.
Oh yeah. Well, that's a perfect example. I'm trying to be hopefully there, that I'm not reliant on this income. I think I have experience tutoring people in college level, high school level, and a single MBA level. So I think I'm in a position where, for better or for worse, life took me through that path, and I am here, and I think I can provide that to people. And I'm thankfully in a position where I don't need someone to pay me the $1,000 for the course. I'm willing to give that to the world, because I already had this discussion with you in private. I think it is good that we help as many people get into the investment game, get them serious about thinking about improving their financial, and that improves society. It does as a whole. It really does.
I'm gonna say this. We kind of talked about it in private, and I know you don't like to mention names, I'm so sorry if I do this.
No, you're good.
You know, I'm part of Jeremy's course, right? And it's about Aspire on this month. I did it last year. You know, and I was thinking, because you know how they make it him, not calling him out specifically, just everybody, how he makes it out to be just like, you know, if you join it, you know, you're gonna get specialized time, you know. And I know he has, you know, let's be honest, he has a bigger following than you. Then again, you just started. He, you know, been doing this for a long time. But you know, I wasn't able to really, you know, get that kind of connection. It was always in his course. It's more of his coaches, but his coaches are not the face of the YouTube. It's him. You get me? So you know,
Yeah.
I found it, you know, really, you know, really cool that, you know, that you took your time to, you know, talk to me. You know, one of your subscribers. You know, I don't, you know, I gone through his videos 1,000 times probably. I haven't seen a single video with a subscriber. You know, so you know, it tells you right there something about the person. You know, I'm not gonna say what that means, but you know, let people decide.
Let people imply.
That now I am gonna give credit to him, to you, Strongman, to me, Kevin, Grant, Stefan, everybody. I think, like you were saying, and you know, we talked about this in private. In general, it's a better thing that this is going on. It does hurt some people. I do understand, but I think it is better just because it shows everybody that you don't have to work a 9 to 5, right? Now you also don't have to do this scammy little Amway trick to become rich. You get me? There is, you know, a legit way of investing, and you can do it with discipline. And throughout your life, when you retire, you don't have to be on Social Security. You can probably retire, you know, humbly, you know, and have a good life, and, you know, spend what, you know, money you have to the things you like. Don't want to get, you know, too much off topic with you, but yeah, tell me, why did you decide? I know you decided to this, you know, you have to be you have to like what you're doing. You have to like teaching people to do this.
Mhm.
But is there any specific moment in your life that triggered you making a YouTube channel to teach people? Have you ever been in any kind of like hardship, or have you seen anybody and close to you that, you know, has gone through some rough patches with finance, that you were like, I think that maybe some people could, you know, watch this and learn this?
I think the second part, everyone's kind of seen in some degree, someone in their life go through some hardships. But if I'm being honest, for my unique circumstance, what triggered the creation or me going down this path is actually my inner circle, because I didn't really have a lot of time to watch what was going on. But my inner circle kind of saying, they started getting into investing, and they got in because of YouTube, which is why I agree with you. It's not, there's some good things because it gets people into it, right? Now we can talk about all the harm and all that, but it got people into it. It got these individuals who I knew into it. And the thing is, look at this. I work where I work, and I didn't really have these conversations with them. It took YouTube to get them into it, right? But we were very good friends. We were very close friends. And so something else brought them into the fold that wasn't, you know, interactions with their close friend. You get what I'm saying? And so that was a net positive for them, because now they're taking it very seriously, and they're learning how to manage their wealth. They're growing their wealth. They're learning every day. But what kind of triggered it was when I started, they got interested, and then they started, you know, texting me about these things, or calling me and asking me and talking to me, having these conversations with me. And I started to notice some of the information that they were saying was interesting, to say the least, questionable in some instances, and sometimes very bad, you know, because there's a whole range. We can agree there's a range of information and quality of information on YouTube. And so I was like, wow, it's kind of like there's a lot of people who want to learn. They're looking, they're trying. And then there's the, you know, at the same time, which I don't think there's needs to be like regulation or anything like that, by the way, but there's a lot of involvement by people who have different motives, right? And different motives, you know, sometimes it's someone who has no idea, right? And they could be sharing their opinion. I actually want to say that they could be sharing their opinion and stuff like that, but it's kind of like the Wild West in YouTube finance at the moment. My opinion is that it's okay that it's the Wild West right now. Over time, it will evolve, and hopefully the good ideas will rise to the top, whatever those good ideas are. Maybe my ideas are terrible and it, you know, gets
I'm listening.
but that's the capacity of what basically could happen over time. It will improve. And just that was the motivation, was, you know, talking to them and saying, oh, where are you hearing that from? They'd be like, oh, I'm listening to it on YouTube. And I was like, okay, you know what? Enough is enough. I can't complain about it if I don't try to do something about it.
Okay. No. That's good. Cool. Let me ask something, right? Because I saw this interview a few days ago with Kevin O'Leary. Now he says that, you know, somebody that I know investing in a lot of small companies. You know, I know it's like the big hype right now, investing in small companies, right? And one of the things he said, a lot of companies go broke, pretty much. Just it costs more money to get the customer, to acquire that customer, than what they actually spend throughout the whole time of the company. So pretty much he said, you know, they literally advertise themselves to that. Now, how would you be able to see that with an unprofitable small company? Where does that show up in a financial statement? Exactly.
Well, that actually,
question, if I can ask, is there any way you can maybe pull that off? Is that something that you can do right now, or not possible?
We can talk about a specific company, because that's actually the thing I'd have to say. It depends on the company, how you would really find that out. Some companies will tell you, and they'll say their dollar retention rate, right?
Got it.
So if I say, because pulling up a company, I'd have to think of one off the top of my head. Typically, software as a service businesses, SaaS companies, they show that off a lot, and they call that dollar retention rate, net retention rate, stuff like that. And they'll showcase that as a measure in either their presentation. If it's a good number, they'll show it in the presentation. But if it's a bad number, they'll try not to showcase it too much. But that is definitely an important metric in those kinds of businesses. Obviously, for example, Procter & Gamble does not measure that. Procter & Gamble will measure market share. That, how we would calculate that is, you look at the total size of the market you're looking at. That would be, you know, a Google. You look at the sales figure of Procter & Gamble, you do a division, and you get a percentage. And that's one way that you could measure how much of the market they control. But for them, it's different. It's not, you wouldn't measure as a dollar retention rate, because that's kind of like a subscription.
Market share, pretty much.
Yeah, market share or a retention rate. So if you want to see a good retention rate, look for something that's above 100%, because that means they kept everyone, right? Not literally they kept everyone, but in terms of amount, they kept 100% of previous
acquired,
plus they acquired more. So that would be what you look for there. And if with companies that you don't measure that in particular, something like Procter & Gamble, Unilever, these kinds of businesses, you want to look at market share, right? Which is not something you measure directly in the financial statements. You measure beyond them, right?
Understood. Talk to me a little bit more about, because I know, and hey, I want to talk a lot about unprofitable business, because I feel like a lot of new investors, penny stocks, unprofitable business. You know, pretty much, if you want, nobody's happy about Coca-Cola. Nobody's happy about Visa. Nobody's talking about it. So what about price to sales? What will be a good price to sell for a non-profit company, and what does that tell us? Exactly. Break it down for me. Imagine I'm 100% new stock market.
These are really good questions.
PNS.
I like them.
I saw PNS right on Yahoo Finance, right? And you know, I'm your buddy, and I go, hey Fabio, I know you've been doing this for a long time. What is PS? What does PS mean?
Yeah. So for those of you some of you may not know, the price to sales is simply calculated as the price divided by the sales, exactly as such. Well, sorry.
Now, price is that, price is it talking about like market cap? Price is it talking about the actual, like, how much is it, like the stock price? Like, what kind of price?
Very good question. So that depends on what sales figure you're using. If you're using sales or revenue per share, you will use the stock price. If you're doing revenue as a total, you would have to use the market cap, right? Because the market cap is the sales number, hypothetically, if you had enough money to buy the whole company today, that's the market cap. We're not talking about enterprise value, but we're just keeping it simple at market cap. So for price to sales figures, the thing is, the industry does use it as one way of gauging how expensive it is, typically in relation to another business, not in isolation. That's what people kind of miss out on. It's a comparative measure, not an isolatory measure. I just made that word up probably, but what I mean is isolation. So isolatory. If that is a new word, for those of you who don't know, English is a language that is a decentralized language. Yeah, unlike Spanish.
So you're telling me wait, I heard decentralized and I heard language. So 100% Bitcoin.
Yeah, Bitcoin.
Yeah, Bitcoin 100%.
Yeah.
Let me ask you something real quick. All right, so but I want to go back to price of sale, right? Because I keep hearing.
Let me adjust my camera because I'm out of focus.
You're good. All right. So price of sale, I've been hearing, a lot of people talking, price of sale this, price of sale that, right? So let's say, let me just throw some numbers out there, even if they're not correct. Right? There has to be some kind of standard, right? Because I imagine, let's say, if Coke is trading at a price of sales of 1, but Palantir is price of sale of 7. Is Palantir too expensive? Is Coke too cheap? How would there has to be some kind of range? You know how we have from PE, we have a range of, I believe it's from 14, if I'm not mistaken, all the way to maybe 20. That's a good range. 14 being the low end, 20 being the high end. What would be a range for price of sales?
Okay, so very good questions, because here's the answer to that, right? So the reason why a software business tends to trade at higher price of sales has everything to do with what the financial analysts are projecting as the future margins. So let's use 2 companies. I'm going to use as easy as the numbers as possible. Both companies are making $100, right? Okay. Before we get into price of sales, both companies making $100. Company A has a 10% margin, so they make $10. Company B has a 50% margin. They make $50. Okay. Right. So when we look at the companies, company A should trade at what level of price of sales versus company B? Probably lower, because the end result, right? When we look at the margin amount, and then you look at PE, right? Let's keep it simple at PE. The PE of company A and company B would be different, right? If they were trading, let's say, at the exact same price. Let's say both are trading at a price of $100. So company A has a PE of 10, and then company B has a PE of 2. The market would never price those 2 companies the same. Company A would be, let's say both of them, you want to make them a PE of 10, right? So company A would stay the same. Company B would turn into a $500 share company. Okay. Now on a price to sales, let's go back to price to sales. Which one is now looking more expensive on a price of sales? Company B, because we just said on a PE, let's say they're both 10, it's at $500. Well, we take the $100 sales figure, and it's at a price of sales of 5. Company A is at a price of sales of 1, right? What's the difference at the end of the day? It's that margin. Okay, so now going back to Palantir, Coca-Cola, the reason why some companies, the industry says that they should trade at higher price of sales is because they're thinking of the end margin amount, and we can't calculate the margins yet because they're not there right now. So what we make is projections, and then we look at the price to sales as a smell test, because for example, a software business has higher margins than a industrial business, right? We're talking like a software business has gross margins of 80%.
Yes.
And then net margins could be anywhere between 20 and, in case of Visa's is quite literally 50%. Okay. One of the highest margins in the entire world. So anywhere in that range is where you'll find it. So therefore, a sales figure, when the company reaches profitability, is more valuable in a high margin business than in a low margin business. Ergo, you have you will say in valuations, a software business or a high growth software business will have a higher sales multiple than and that we're talking about a non-profitable business. The reason why they even look at it is because they're making projections underneath that all when they will be profitable. Because at the end of the day, a business is only as valuable as what it can return to you as an owner. Like if we do a private business and I tell you, you're going to make an investment in my business and I will never give you a penny. What is it worth to you? And it's private. There's no stock. Like you can't sell it.
Yeah.
In the market. It's worth about this much to you.
Yeah.
Right. But we're avoiding the whole topic of reinvestment and all that, because what you're buying there is the potential. So you may say, I'm not going to pay you a dividend yet. I'm going to take all the money, I'm going to reinvest it, and I'm going to grow it. You obviously say yes, because what you want there is the potential that in the future, I will have a lot more to give you. Okay. So that's different. I want to separate that because I know some people will be like, but technically, no. Like Google's different, or all these other companies are different. I'm talking specifically about the bedrock philosophy of business.
Now, let's say me, right? Let's say, or anybody in general, right? Hey, Fabio, my life's very tied up. I have, I have 2 jobs just to make ends meet, to have a lot of money. How can I get, without going to college, how can I get to a level of knowledge that you have? What will be the best way?
Okay, so there's plenty of free resources, and I'm hoping to, again, contribute to that in my own capacity through my YouTube videos and also through the Pay What You Want course, because technically that's going to be a free resource. So hopefully I'm going to contribute positively in that manner. But even without my contribution, there is a lot out there. There really is a ton of information out there. For example, if you think of definitions, learning definitions, Investopedia, right? That's like a dictionary of investment topics, a dictionary of formulas. You could find out the formula for pretty much every single investment concept. Every single ratio is out there. Of course, this is what I'll say. Once you learn all the ratios that are there, or you understand the philosophy of them or the understanding of them, there's nothing stopping you from creating your own in the end. I'm getting off topic, I know, but you will build that understanding, then you'll go beyond it. That's when you know that you're like not evolving, but you're kind of evolving. Once you start to say, I really want to see this metric because I think it's important for me to judge whether or not that's a good business. And it doesn't exist, but you have the tools after you've learned it to create it yourself, right? Because at the end of the day, all these ratios is just fractions. They're ratios in mathematics. You divide one number by another, and that's it. And accounting follows not always, but for the most part follows the same principles. Of course, if we're talking about GAAP, there's IFRS, and then there's cash basis accounting, but not getting too complicated on there. So to finalize the answer, there's so much out there in the world that's free and available. That is fine. And then if anything, there are tons of books if you really want to, if you're a different type of learner, because I think we talked in private, you like the visual. So some books that are really good to kind of get the understanding is, I'll say the classics, because whatever, but The Intelligent Investor. That's one that I'd say is later down the line that someone should read into. I think someone should look at 100 Baggers, but also 100 to 1. 100 to 1 is probably better than 100 Baggers, because 100 Baggers is about that one. That's kind of going into the concept of finding very good businesses that are compounders, and it kind of gets into your mind, the idea of you want to hold the winners, don't play too much with the soap, that kind of philosophy. Again, The Intelligent Investor, save that for maybe later down the line. Margin of Safety is another one that's pretty good. And those are just off the top of my head. And you know what? I think, where is it? No, I don't have it here. Yeah, because I was going to say, I'm going to do a shameless plug. Where is it? Okay, I guess I don't have it here. But Strongman would kill me if I don't mention his book, but Strongman's book's a good book for beginners as well.
Stop Being a Broke Loser, the best book ever made.
He's gonna love it. But anyways, no, there's so many books if you're wanting to pay and you're a reader, right? But there's a lot of books out there with different forms of how to get them. I didn't say that, but like for example, Margin of Safety by Seth Klarman is very expensive, but it's out there, so you can just read it. There's plenty of ways to get your hands on that book.
Okay.
Yeah.
Oh, sorry. Are you done?
No. That's pretty much it. Like,
all right, now, okay. Hey, Fabio, again, man. You know, I'm reading some books. Everything's kind of clicking, but everything makes sense in theory. You know, it's all great, but I see this stock. You know, I go on Yahoo Finance. I scroll all the way down. I read the story, and but all I see is ratios and this and that. How do I get started at looking into a company? What are some things at the beginning that I can look at so that I can be like, hey, this one is something to look forward to, or to be like, not for me? What does that have to be? I don't understand it, man. Can you help me out? What would you say to that?
Okay, so I kind of thought about this kind of more recently, but I think the first question is you ask yourself, because it depends on the person. Are you more of an analytical person, or are you more of an emotional person before? Because I'll say for both scenarios, if you are more of an emotional person, then it is very important that you understand the story of the business that you're looking at. Very important, because emotions tend to make us, and I have to be careful how I say this, it's not that you ignore the analytical side. It's kind of like the order in which I think, and I haven't geared this down yet. I have to really think about this a little further. So this is kind of off the cuff, but I think that an emotional person, it's very important that they understand what they own more than the analytical person. The analytical person, for example, I'll give you an example of someone like that. Paul from Everything Money. He is, I look at him, I'm not a psychologist, but he appears to me that he's more analytical than emotional. So his priority in investing is he'll look at the numbers and exit immediately just on the number. He doesn't care about the story of the business, but that's his style. For someone else, that's not going to be a necessarily good style. For example, let's say you're more of an emotional type of person and you enter a company just because you did your calculation or whatever, and it looks cheap. And you just buy it. You don't even care. Well, what happens when something goes wrong? Let's say temporarily, let's say it's a temporary problem. It goes wrong. The stock's coming down. You don't know what you own. You only bought it because you thought it was cheap. You're more likely to make a mistake there and sell. Okay. So for those types of people, it is perhaps more important that they understand what they own. Now, I'm not saying that you do one or the other. It is a balance of the two types, of the two styles, right? I think people should be both, but I'm saying in terms of where do you start? For someone who is analytical, they probably start there, but do they stop there is the question. I don't think they should. I think they need to go past that and say, okay, what is it do I own? Is there a future behind it? And I want to understand this business on a different level. An more emotional person than analytical, I think maybe is a good idea to start there and then not just stop there and say, oh, I love the story, I'm going to buy it. No. Then you go into the other side and you analyze it responsibly. And you say, okay, is this at a good price? Is this at a good risk reward? That kind of thing. Because it's a balance between the two. I think some people want to be one or just the other. And I think that's the wrong way to go about it. And then at the same time, we have to know ourselves as to which one do we start at? I hope I explained that well.
No, it's all good. Now, let me go one step further than that, right?
Yeah, let's go.
All right. Hey, Fabio, keep hearing some YouTubers and they keep telling me that finance, that, the actual, fundamental doesn't matter. It's all about the story, right? And then I hear some other YouTubers, right, that they tell me, if the company's not profitable, I don't even want to touch it, right? Can you tell me, can you find me a middle? Can you tell me what's good and bad about one side, and can you tell me what's good and bad about the other side?
So yeah,
can you try to understand me?
Yeah, of course. That's definitely adding on what I said. So I see what you're saying. These are really good questions, by the way, because they're really making me dig deeper. So the pure analytical side, again, because no one is pure analytical, right? Some people are far more analytical than others. Like it's like a psychological bell curve, right? You have very analytical people and very emotional people, but most people are in the middle, somewhere along the middle, right? So like it's a spectrum. So essentially what I say is everyone has some emotion, unless you're, psychopath or something like that. And everyone is also analytical. No one is completely just emotional as well. So I'd say the one. So yeah, basically with analytical, just to summarize, and then we finish off at this point. Analytical investors look only at the analytical side of the business, the numbers, but then they ignore the story, which can cause some people, if they follow that style, to not understand what they own. And then emotional side of the investor it's almost in the exact same way, not know what they own, but from a numbers perspective, right? So they look at a story, and let's say they buy something that has a fantastic, let's use Snowflake because that's an easy example. They bought Snowflake at the highs. They listened to CNBC or all these different people saying, look at the wonderful technology. They love the story. And let's say they even work in the industry, right? That can happen too. And they say, yes, that's a really good business, whatever. But let's say you don't care that you're paying quite literally an arm and a leg for that stock at that time. Well, then what happens is you get that massive drawdown, which could be mitigated had that person also balanced that out with some analytical thought, right? So every investor kind of needs to be a blend of both. So, Buffett says it's about, and I'm going to quote Buffett because everyone kind of can relate to Buffett. I could quote other guys like Howard Marks and stuff, but people know Buffett more, which is why I use it. But he says, like, you have to know the business, but then he also just doesn't only buy businesses he knows. He has to know it and he has to evaluate it both at the same time. So that's kind of my thought on that. If you're too extreme on one or the other, there's going to be mistakes made.
Now, I want you to explain something to me, right? Let's say I'm investing in Tattoo Chef, right? And, I'm in Yahoo Finance, trying to learn a bit more. And, I keep hearing, some YouTubers telling me that they dilute me. What do you mean dilute me? What does that mean? Very
good question. All right, so let's go ahead and pull up Tattooed Chef on Yahoo Finance. This is the farmer choice. Let me adjust our size so we're not too small there. Okay, so this is how the average person, I guess, would come up on Yahoo Finance. They look at Tattooed Chef. What are the first things some people look at? Well, they look at the market cap. Yahoo Finance is, they have the 1-year price target right here, right in your face. But you're asked your question. Let's go straight to your question immediately. Let's go to financials, and we should see on the balance sheet the shares, and they don't have actually much data, unfortunately. I wish they would have like a breakdown quarter. Maybe how, and there it is, quarterly. Okay, so quarterly. We see here line item, shares issued. Okay, so this one is adding to the amount of shares, unless that's aggregating incorrectly, because sometimes websites like this sometimes don't aggregate the data as correctly as they really should. So I'll actually present an alternative, and let's go here, because I'll show you this one's better. It's a little bit of a free website as well. Oh, almost spelled that ticker wrong. That was funny. So here we can get even a visualization. If we go to charting, pretty simple, and we go down to diluted weighted shares.
And what website is this?
This is Seeking Alpha. It's another free one. Seeking Alpha is another free one. There's a ton of free ones, but I'm just saying this is not. I wouldn't, if I was designing this website, I would not have formatted it this way. Because, for example, I should see a line item somewhere around here where it says total shares, but it's looking weird. But I can kind of look at this and be a better judge. So right here, it does appear as though this is a perfect example doing it live. This line item is actually the total shares outstanding. But they're calling it shares issued, which can confuse some people. And it is confusing me too, because it sounds like you're creating, these are the new shares. No, this is actually the total shares. And I'm just confirming it. And by the way, I do this all the time because all these websites use different APIs. Sometimes they use the same, but sometimes they organize it better than others. So I'm just using this website to confirm, and then we'll go back to Yahoo Finance because a lot of people use Yahoo Finance. All right, so this is not actually how many are being created or issued. This is literally, quite literally, how many exist. Okay, so to answer your question, dilution, we can see that in this quarter right here, They had 71.6, and then now they have 81.9. So they basically 82. So this difference, right, is dilutive to you. It's a cost. Now they show that here in the income statement, or they should. Hopefully it's, again, aggregating correctly. It should be kind of down here, actually. Total income, reconcile. Sometimes they don't aggregate it in a nice way. Yeah, they don't have it. But usually we add it back in the cash flow statement. Let me see if they aggregate that here. And cash portion, CapEx should be here. Expand. Yeah, right here. So they added it back in cash flow. So a lot of people like to say, and slow me down, by the way.
No.
So Yahoo Finance, they don't show you everything. You got to actually open these up, right? So open operating. When they add back share dilution, it will always be in operating cash flows, because the idea is, the reason why we're adding it back is it's not an operating expense. A lot of people say it's not a real expense. No, it's a real expense. Don't let anyone tell you otherwise. It is a very real expense. This is basically, you are paying it. Think of it like that. You are paying for it. So if you see a lot of expenses here, the company is not paying for it. The investor is paying for it. Yeah, that's how you should think about that. So if you see now, no, you ask.
No, tell me. All right. So let's say that all right. So let's say that, you know, there's just a brand new company, right? I'm excited for it. It's profitable, right?
Yeah.
Now they need money, right? And I'm the investor, right? And they decided to issue more shares, right? Now they issued more shares because they would like to acquire more money. Am I correct?
Correct.
All right. Now, is that something bad? Do only unprofitable business do that? Is that something that profitable business do that too?
Very good question. All right. So that depends on the cost of capital, right? So if I am the management team, right, I need to, and I have a fiduciary responsibility to you. You're my shareholder, right? I work for you. I'm the I'm the CFO, or I'm the controller. What does that mean? I have fiduciary responsibility to you. It means I have to make decisions that are to the best of your behalf, not my behalf, but by extension, the business's behalf. Well, so when I have to look at how we're going to get money for project A, right? Well, I have to consider, and let me get rid of this for now, because there's no point in having that. I have to consider, how am I going to get that money? Each type of way of getting it will have a certain cost, right? We have debt, very easy to understand that. Let's say the interest is 10%, okay? Because our credit isn't very good, and the companies or banks, wherever we charge, we're only going to get like 10% on that debt. But we calculate it. I won't get into the calculations yet because that's a little more complicated. But let's say we calculate our stock value as a percent cost, making it simple, and it's 6%. Which one should I choose? Should I dilute, or should I issue debt? Well, the answer is, in that instance, is dilute, because the cost is less in that instance. A very good example of this is REITs. REITs are a very good way to wrap our heads around this simple exercise, because you know what a REIT is, by the way?
I do not know what a REIT is.
REITs are publicly traded businesses that you could buy today, and you would own commercial real estate. It's a way of you owning commercial real estate. I won't get into like the taxes and all that, but it's a stock. Think of it as a stock. You buy the stock, the company, what does the company do? They buy real estate. They collect rent, they pay you a dividend, whatever. So when you buy a REIT, and I'll actually take us to Yahoo Finance, because this I can actually show with a real world example. Let's look at this one, which is, okay, I'll just press enter because that's the ticker symbol. I don't know what, that's not the ticker symbol. Ticker symbol O, there it is, Realty Income. All right, so we take a look at this REIT. It's $65. I don't really care about this right now. This is a dividend yield for the business, right? 4.53%. Let's say the debt level is, or the debt cost is like 10%, right? So if I issue shares, it's going to cost me 4.5%. If I issue debt, it will cost me 10%. I'm oversimplifying, but let's just say those are your comparison. And let's say I buy a property. Like I see a property and it costs, in the capped rate, the percent I'll make from it in terms of rent is 7%. I chose that number on purpose to make it easy for us to make a decision. So if I issue debt to buy that property, I will have a negative percent contribution rate. Okay. So because I borrow money for 10%, I buy a property for 7%, negative 3%.
3.
But if I issue shares and I buy that property for 7%, I'm paying a dividend on those new shares of 4. Let's round it down to 4 to make it easy for me. 4%, which gives me a positive 3%. So in that instance, it was better to do the share dilution. That's why I say REITs are a really easy way of us conceptualizing this. Businesses are the same, except you have to think of it in terms of projects. Do I buy that new business? Do I invest in that new factory? Same thing, but the basis is the same. You have to consider the cost of the capital.
Okay. Now, Fabio, again, I'm new, don't understand a lot. And I see Yahoo and I see it has a finance tab, and then it says something about balance sheet and statement of cash flow, all that kind of stuff. What does that mean? What is it in each thing? Not don't break it down line by line, but explain to me the whole gist of each form.
All right. So if I go to the financial statements, right?
Okay.
I have to say this joke because he will roast me if I don't, but the balance sheets, it's not called the balance sheets. These are the financial statements. You have the income statement, very straightforward. This one is measuring a continual time frame. Okay. So it's accumulating, right? So we have revenue is accumulating. So so we have trailing 12 months, right? So the trailing 12 months sometimes is not the best to look at because it's accumulating. It's not a stagnant moment of time. It's not as important to conceptualize this in the income statement as it is for the balance sheet. So I'll show you this. If we go to income statement and I go to quarterly, the quarterly data will only show, obviously, the quarter, and that's it. Okay. But the balance sheet, if I go quarterly, it's telling me everything they have right now. So you see the difference in terms of timing. This one, if I want to know how much debt they have now, I need to look at the most up-to-date version of it shown in the quarterly statements. But in the income statement, do I want the quarterly income or do I want the annual? Well, then that depends. But for the balance sheet, the best one is technically the most up-to-date one because that's what it is now. Okay. And these are governed under GAAP, generally accepted accounting principles. So they follow a basically almost the same structure every time, depending on what company, not depending, because you'll find that there's some companies that are IFRS. Just think international companies typically will use IFRS. That will make things a little harder because these websites sometimes make big mistakes. I've talked on the channel sometimes of how these websites, they make some mistakes in how they show the data. But that's because, this is used to GAAP accounting. When you throw in IFRS, it changes some things around. Cash flow, the statement of cash flows, this is a non-GAAP financial statement. It follows it. Well, when I say it's a non-GAAP net income, let me just stick to that because somebody will be like, well, technically, the operating cash flow, this is where you'll see all of the amount of money. Actually, I'll get rid of this. We don't need to look at that. We just need to look at this. This shows the amount of money a business is making for like the cash, the actual cash money, right? From the business in the operations. And let's see if where is it? It's supposed to be here. Cash from continuing operations, financing. They don't show it. Well, they calculate it for it's here. I'll show you in another website, but this is the free cash flow. You'll see that's pretty much the same because for this kind of business, we don't have CapEx. Oh, that's why, because we don't have CapEx in a REIT. I was looking for something that doesn't exist because I forgot we're on O. So operating cash flow minus CapEx, that should be your free cash flow. And they calculate it for that here. This at the end of the day is all the money that can be given to you as an owner. This, why is this here? Why do we care about net income? Well, net income is a GAAP metric. And net income, if I can read net income, where's net income?
Wait, I have a question for you. So you said net income 3 times. Does the straw man appears if you say 3 times?
No, but we'll
should
see.
Be here right
Maybe
now.
It shows up the Zoom link.
So now let me ask you something, right?
Yeah.
What's so important about? So let's say that a company is how how can we project if a company is going to become profitable, right? Because I know you said net income. Can you? Well, I want you to finish all this. First explain everything. But let's say that a company is unprofitable, but it's on a way of becoming profitable, right?
Oh, good.
How do we see that?
So let's take a look at Palantir. Let's just take a popular stock. Let's go to financials. All right, so let's take a look down here. So I haven't taken a look at these in quite a long time, to be honest. So net interest income. Let's see if I'm pretty sure for this one, net income from continuing operations. This one right here. So they're not profitable on a GAAP basis, right? And let me make sure.
GAAP basis meaning?
GAAP is just the generally accepted accounting principles. Think of the regulation. To keep it simple, it's technically not the government because it's FASB, but think of it as the regulation of how people report, and we standardize it. The point is, the reason why it was done that way is to make it easy for us to look at companies. So everything looks the same, so
standardized way.
Yeah, standardized way. All right, so I'm taking a look at that. Income statement is that, okay, it's negative. All right, now next thing I'll do is I'll look here immediately. Okay, so we actually have a positive free cash flow. So right there, I can say this company can become profitable right there. Yeah. And the reason why they're probably having negative earnings is this one right here. Yeah, look at that. So they are expensing a ton of money in stock-based compensation. That's an expense that's showing up here in the net income. So if I go to net income,
compensation, my understanding of it is they're paying the employees in stock, correct?
Yes, they are. Right. And who's paying?
Is that a good thing or a bad? All right, now let me ask you something, right? Let's say, okay, because because I heard, and tell me if it's right or wrong, it's usually a good sign if you see that management has a high percentage of stock of a company, because then literally they're incentivized of making the company as profitable as possible and as good as possible for themselves, right? So let me put it to you this way. The company is profitable in a non-GAAP basis, correct? All right. And they're issuing a lot of stock to employees, right? And we would imagine that large amount of them will be to management.
Yeah.
Could imagine, because I don't think it's just a regular employee is going to get a bunch of shares. Usually goes to management, correct? Wouldn't that be too bullish catalyst for the stock? Not technically, in general, as just creating a picture.
Yeah, it would be in the sense that if we see that management acquires the shares, holds on to the shares, they have a better picture a lot of times than us as investors as to the performance of the business. If they're holding on to the shares, that is an indication that they believe, because no one would do that otherwise. No one would get shares and hold on to them unless they're forced to, if they think they're going to go down in value. Okay. Of course, you could argue optics, they're worrying about how other people will think about them, whatever. Keeping it simple, most people, if they think that the stock price will go down, they're going to want to sell out and take the money. So if I see a company that has negative because they're issuing stock-based compensation, exactly to your point, it depends on certain things, whether or not that's a bad thing. I'll say this, you got to be careful of excessive share-based compensation, because yes, you want to retain talent. That's true. That's a true statement. But what I'm trying to highlight here is you can kind of predict that Palantir will, and I always pronounce that wrong. I got that in the comments section that, oh, you're pronouncing Palantir wrong. Whatever. You can predict here that Palantir can become profitable in the future because they are scaling. The thing that's causing the negative amount on a GAAP basis is stock-based compensation. But you should not dismiss stock-based compensation as, oh, that doesn't matter. No. That's who's paying for that. You are. If you own Palantir stock, you're paying for that. Now, the question then becomes, now we move on to the next question.
Hold up, before you go continue. Stock-based compensation is technically a type of dilution, right?
Yes. No, it is dilution.
All right. Continue, please.
So is the dilution being utilized in a positive manner, right? And that's going over, are they raising capital to buy projects or invest in projects that will give a higher return than what it costs? Or are they retaining employees that are insanely good? These are very important questions, right? Because if they're not, then it's you are being dilutive on a value basis. And I think it's very important to distinguish between the two. There's dilution, that's just dilution. And then there's dilution on a value basis. So if you check like the model I use, I have something called dilution accretion, which is a measure I created to measure exactly that. If a company is diluting me, is it showing in the numbers that it is positive relative to how much is being diluted? The way we can kind of guesstimate that very quickly in our minds is saying they're diluting me by X amount on a percentage basis. How does that compare to the growth in cash flows on a percentage basis? Because remember, how do we have to compare things? We have to compare things on a scaled amount. Because if you look at raw numbers, sometimes you don't take appreciation for the scale. And I can maybe explain that a little further if you want me to, but
please.
Yes. So if I look at the sales of Apple and I say Apple's, I don't know, let's make up a number, 100 billion. All right. And another company is 2 billion. Which company is better? Well, I don't know, because you know, let's say Apple's growing at 2% and the other company is growing at 300%. Let's say you know that. But if we look at the numbers, what that ends up being, 2% for Apple is $2 billion. And let's say I don't know if I said the number for the other one. Let's say the other one's 1 billion. If it grows by 300%, actually let's change that to 300 million because it makes it actually, or 100 million makes it better. 100 million, it will go to 3 billion. Which one's better? Well, the one that is, oh, sorry, I did that math wrong. 100 million goes to 300 million, not 3 billion, 300 million. So if you look at the raw number, Apple looks better because they made $2 billion. But the other company, they only made $200 million. Apple's clearly better. They made more money. No, because you got to take into account scale. So when you look at percentages in math, you take into account the scale effect. So with share dilution, you want to make sure that if they're diluting you, that the benefit to you as an owner is more, right, than what you're losing, right? Think of it like when you're buying something. Why do you buy something? Because you believe that you're giving someone money for, and that what they're going to give you is more valuable than that money. That's why you're giving them the paper. Same thing with shares. Is what you're getting more valuable than what you're giving up? Harder sometimes than other times to make that judgment, but that's a judgment we all have to make when making an investment. But this is an example again of, to summarize, where I can say they can become profitable when they want to, because you see that free cash flow. They're just expensing a lot right now on something like well, it's not, again, this is weird. I'd show you on a different website where it kind of can show, or they'd show it on their net income statement. But it should be there as an expense. Maybe I'm blind and someone watching this video is going to say, well, it was right there the whole time.
Question, Palantir, right? You have bought it before and then you sold it, and then you made a prediction, an assumption that it was gonna go. It was a fair value, if I'm not mistaken. You said somewhere around the $8, if I'm not mistaken.
Well, I have to check it out again, but originally it was like $5 to $8 around there.
Yeah, $5 to $8. Sorry, correct. Can you run me one more time? Why did you make that prediction, and what did you saw that triggered that?
So at the time when that evaluation was made, it was simply based off of the projections as far as how much cash the business can produce over long periods of time, based on the growths that I assumed at the time, which I think were between 20 and 40% on the high end. 40% on the high end, 20% on the lower end. And some people might say it's more conservative than what they think. You know, everyone will have different opinions as an investor.
Yeah, at that point it's, you know, all opinion based. But that's just numbers that you use.
Precisely.
Okay, and the 20 to 40% is what exactly? Sorry.
The growth rates in the eventual cash flows, right? So and you have to evaluate when you think
margin. Would that be margin?
Yes, cash flow margin.
Okay,
you exactly that. Use the word properly. So
got it.
they actually became cash flow positive this year. However, like I showcase in the videos, oftentimes I do account for dilution in the videos. And so if you look at the cash flows growing, but you don't take into account dilution, your value is going to be off because you're not taking into account that you're owning less and less of the pie. It's very important to really think about that when you're considering an investment. Some businesses will do it more than others. Again, but it's not always bad. It's not always good. You'll notice I'm never in that camp of investing. Something is always bad. Something is always good. It's depends, like dividends versus non-dividend investors. I understand. And actually there's benefit to both, but a lot of people are one or the other, right?
Understood. Okay, now. Okay, and I have a question now, okay? Because I keep hearing that if a company has a lot of cash, right? That's great. That's amazing, right? What does it exactly mean that they raised a lot of cash?
They raised a lot of cash. Okay, so when a company raises a lot of cash, you're probably talking about an IPO, or you're talking about a dilution event, or you're talking about when they took on a lot of debt, right? Because having a lot of cash, that depends. Actually, I'm going to show you a company I haven't shown on the channel before. It's a really good case study to learn from, and it's a company that's balance sheet is amazing balance sheet, but it's not a company I'd ever buy. And you're going to look at it and you'll be like, wow, everything looks like it's amazing. It's a really good case study. But regardless, when you talk about cash, it depends on what you're comparing it to. Typically, the best way to compare it to is the liabilities, right? Or the debt. Cash to debt ratios, you can create whatever ratio you want, but if you have a lot of cash, but a lot more debt, right? That's not that big of a deal. I'll look at, AT&T. Let's actually pull that up. Let's pull up AT&T and let's see. I haven't even seen their balance sheet in a long time, if I'm being honest. So this will be raw. I'm seeing it with you. So let's go to the financials. We'll go to the balance sheet. All right. So let's take a look at the assets. Let's break it down. Okay. This is kind of frustrating to do all this over and over and over, but they have $21 billion in cash. And again, let's go look at quarterly to see the most up to date. Yeah. Okay. They have $21 billion in cash. Again, I'm looking at quarterly for the balance sheet. And then let's go down here to the total liability. So it's going to be in here. We want non-current. Okay. And then long-term debt. Oh, we want to break that down because it's long-term debt and something. Yeah. But technically this is a debt, by the way. This is a lease obligations. So lease obligations, when you have a rent, let's say you sign an agreement for 2 years, you owe that money, right? If you stop paying your rent, they come after you. So long-term leases agreements is still a debt. So let's actually use this one. So let's use this as a debt. So if they have 21 billion in cash, that's a lot of cash. I think no one will say that's nothing in cash. But relative to what? Well, they have 174 billion in debt. So their net amount, if you want to calculate that, is going to be this number minus this number, which if you do that math will be like 153. 153 billion in debt, net debt, we call that. I'll show you the case study of a company with a balance sheet. You've probably never seen this good of a balance sheet. I promise you that.
Well, before search it up, but before you start getting into it, something that I not realize now, but it's something that I saw. How it's very important to have personal finance to be like on dime. Everybody's wants to like run up money, so we can invest as much as possible, live below your means, blah blah, all that. Right? A company is pretty much that same principle, but blown up in size, right?
Yes.
And then, but it's funny how sometimes we're like, this much for rent, this much for this much for that, and then we have extra money, we have a lot of debt. Then sometimes we invest in companies that have low cash, high debt.
Yes.
It's just something that just want to put out there.
You notice how when I made that analogy, I like to do that a lot. I think people can really relate when we start to think of them like us. So when I use the lease obligation, you see how I related it to rent.
Yeah.
Because it's a way when someone's being exposed to this that you can kind of conceptualize. I will do that all the time when I was studying finance and accounting. You can relate it a lot of these terms to your life. And then from there, you kind of really understand it. So this one, you probably never heard of this business. If you have, I'm very surprised. I'm talking about you and the audience watching right now. So this business right here is called GenCore Industries. It's actually headquartered in Florida, very small company. I'm not pumping it because I'm going to tell you that I would never buy this. It's a very small market cap, 153 million. Now let's go take a look at the balance sheet. Oh, sorry. Oh, there we go. All right. So balance sheet's going to be very pristine. Probably one of the best balance sheets you've ever seen relative to scale. Remember that Apple example, scale. This is a small business. So relative to their size, it's the best balance sheet I've ever seen. So look at that cash pile. May I remind you how big this company is in terms of market cap? Let's look at market cap again. They're $150 million company. That's the size of the business. Let's go back to the balance sheet. Let's look at the total assets. Let's look at the current assets. Let's look at the cash again.
Wow.
They almost have as much cash as the value of the business. Okay. Right when you see something like this, your mind should not go buy. Your mind
it shouldn't be undervalued.
Yeah, it should not be undervalued. It should not think, you should not think that. Actually, the correct thing is to think, what is so wrong with this thing that the market is pricing it at that? Right? Look, I have access to the information. Everyone has access to information. It's right here. It's public. Why the heck is the market saying this is no. This is valued this? Because it looks like it's really undervalued just on this cash amount, right? A good case study. How much debt do you think they have?
Well, now that we know that the cash was same thing as their thing, I would imagine it would be high just to.
And actually, I think they have more cash now. Oh no, they have about the same. All right, so let's go look at the liabilities.
101. Okay.
You see where it says long-term capital lease, but there's no long-term debt? There's no long-term debt. They have no debt.
Okay.
They only have the lease obligation.
Okay.
So they have, this is about, I think, $308,000 because we're looking at the size. So this is $308,000.
They can literally pay that off in a heartbeat.
Yeah. They make more money, I think, in interest than their lease obligations. So to give you an idea, let me actually go to their income statement and see their net interest income right here. Yeah, they make $1.2 million a year in interest because they just buy like bonds and they keep it in the bank or whatever they do with it. You see right here, like in low interest rate environments, they're suffering, but in high interest rate environments, they were doing pretty good comparison. So their money went down in this instance. But this is a good case study. So someone like you, what do you think? It's kind of bringing now the question to you. What do you think is wrong with this business?
Well, I wouldn't be able to tell you. I haven't gone that far. But can you highlight some things? So can you? All right. Hold up. Before you continue, right? Imagine you're like, imagine you're like an older brother, right? You're Fabio, my older brother, right? Hey, Fabio, I'm looking at this. It looks so weird, right? What will be, without telling me exactly, where would you guide me? Where would you throw me at to be like, you should take a look at this? Don't tell me exactly what it is. Guide me through it.
Management.
Okay. Now let me ask you, where would I be able to find that information?
So, simply put, let's see. I think they might. I'm just trying to use only them. So they probably have. Oh no, that's in Yahoo Plus. It's probably in here. It's probably behind that paywall. Oh, right here. Holders. Oh yeah, you know that thing you said where you said, oh, 15%. You said high insider ownership is positive, right? Yeah. Here's another one where it breaks that rule. So here we have 15% held by insiders. And let's see here. We have Royce and Associates Limited Partners, Systematic Financial Management LP, Fund LP. We see a lot of LPs. Okay. I want to see the people, and it probably doesn't show the people. But if I just do, I guess, a quick Google search, let me see this. And I say GenCore Industries Management Team. Okay, so I can go to the company website. Oh, no, that's not the company website. Right here, this one. My eye looked at that one, but I clicked the one above it. All right, so let me move us around. Careers, events, upside. So again, I'm not going to even edit all this out. This is a good way to show everyone how to find stuff.
Live. Yeah.
Where are you? Where are you hiding? Careers, contact, about. Okay, it's definitely going to be in the about. Investors. Oh, in here. SEC filings. Okay, if they're hiding it already, if they make it difficult to find, not a good sign.
And this would be all right because then again, it's talking to somebody that just started, right? This will be hard to find. This is
already.
If you have to look. Okay.
I should have already found it by now.
Got it.
It should be fairly easy to see our team, something like that. But you know, if I'm going to the investor section and you can't really show me, or if the about drop down doesn't show me, it just shows companies, etc. Yeah, if I go to investors, usually most companies will have a tab here. Yeah, so it's not a good sign. But the first question is, immediately when this happens, when you see something like that, you should say to yourself, why the heck is the market pricing it? You shouldn't jump to say, oh, it's so cheap.
Undervalued.
When they're very undervalued, usually very, like when I mean very, very, like when you think you found like the best thing ever, you should really look into it deeper, right? Because maybe you did. Let's say you might have found the most undervalued stock in the market. You might have. You have to be very careful because sometimes there's something else. Okay. And then basically after a lot of research, you'll probably find out that this company has dual class. And this is actually another thing I'll look at. So Gencore Industries. Oh, I just want to go there. And then dual class shares. I forgot to say shares. Oftentimes, yeah, right here, I don't even have to go there. The Class B common stock. And right there, I know there's two dual class. Right there, it should take me right there. And vote. Or I'm being kind of stupid in how I did that. It should just be Class B. You want to see? Oh, it's right there at the top. So Class B.
Now, why are there two classes? What's class? What other class are there? Is there Class A? Is there Class C? Or what does that mean exactly?
I think there's going to be only two classes. Yeah, right here. This is what I was looking for. So this is exactly what I wanted to find. So right here, the company's management has effective voting control. They disclose this in the SEC documents as one of the disclosures the SEC will require, because the company wants to disclose as much as it can, simply because if they don't, it opens them up to getting sued, right? And if they don't disclose it, they can get sued for it. So you're going to find a lot of dirt in the 10K, because as long as they tell you about the dirt, they're going to be okay. Yeah. They'll be less fine. I mean, not as bad. So if you read this, it says right there, the title, the company's management has effective voting control. And this is located in the risk section of the 10K. You can see here, beneficially own an aggregate of approximately 96.8% of outstanding shares. Class B common stock is entitled to elect 75% of its board members. So basically, they control, let's go back here, they control how much? 15% of the business in terms of shares. So they own 50% of the economic profit, but they control 75% of the business decisions.
And what about the 96?
That's how much they own of Class B. Of Class B, which has more voting shares. Yeah.
I understand. So pretty much they own 15% of the business, but they're super outweighted in the voting rights.
Yes, they control the business. And next thing you should probably look up is right here. Found first thing, 2006. Yeah, this is about the time frame. So if you had read this, you basically, I'll summarize it. Basically, Gencore was trying to take the company public. I think they lost the lawsuit, Gencor, the management lost. They wanted to buy up the company from shareholders at a fraction of the cost. And remember, they control the board of directors. So yeah, they can just vote that through. Of course, the shareholders, the other shareholders, think of us, we would be the other shareholders. We sued them, we won, and they weren't able to go private. They never forgot that. They don't want to share the money, basically. And remember that very basic philosophical understanding about what you are when you're investing in a business. Well,
you are a shareholder. You are part owner of the company.
Exactly that. So if I never give you any money, I just, pay myself the salary, I'm reinvesting back into the business. I can pay myself in common stock. I can do all these things so I can enrich myself, but I don't necessarily have to share with you the cash at any point in the future. Now, why isn't this stock valued at zero? That can be a question someone might ask. If that's the case, why is it not worthless? Well, because there's always the potential that things change. So if you buy this stock, what you're basically hoping for is that the current management, which is a family-run business, by the way, I'm giving you more information that you don't have to look up, to close this case study. It's a family-run business. The guy was really mad because he wanted to take the company private, but he was sued and he couldn't do it. So then he's still mad about it, and he's not going to share any of the profits with you. In fact, I think he's a net diluter. He's a net diluter of the common stockholders, but he's doing fine. Trust me, he's doing fine. And there's a lot of money.
Let me get it straight. He wants you take full responsibility, a fraction of the reward.
You can think of it that way. Yeah. Okay. But the reason why it's not valued at zero, again, is simply because what happens if that guy passes away and the son says, we're going to do things differently. I'm going to buy back a ton of, we have all this cash. I'm going to buy back a ton of stock. I'm going to give it as a dividend, or I'm just not going to issue any more common stock. And I'm going to change it, and we're going to invest in stocks now. We're going to take this 100-something million, we're going to buy stocks. That would effectively turn this company into where I work at. If they were to do something like that, that basically be the equivalent. Will they do that? Probably. The difference is they're publicly traded, so they actually have to report. But they probably won't end up doing that for the foreseeable future. But if they does do that, there's a lot of value here.
Now, Fabio, I mean something.
Yeah.
So, okay. Hey, thank you for sharing all that with me. Now, question, right? I'm a new stock market investor, right? I'm having trouble. All right. So you saw how you went through a lot of steps together, right? I imagine you know that because you know what to look for. I imagine you have a pattern that you follow or something close to it in your head. I don't know if it's writing, but maybe your head. Let me throw you XYZ stock. Just
go for it.
A name, right? No, I'm saying just in general. Let me throw you some stock out there, right? How do you go about looking at it? Right, because I imagine, you at the beginning, you didn't know that they had a lawsuit. You didn't know about the 15 to 75%. You get me? How do you go together?
Okay, so the lawsuit thing only comes about because I get some hints, right? When I see something that cheap, that's what I'm telling you. That's hopefully the lesson I'm kind of giving off here. It's when it's that cheap, there's typically a reason. Right. I think there's some Chinese stocks, right, that they're negative value in terms of you're basically getting it for free if you believe the numbers of how much cash they have on the books. So someone who just thinks of, they just studied accounting in college and they go, they have more cash than the value of the business and they have no debt. I'm buying free money. No, then there's a reason. And then you got to go investigate that reason. That reason can be very simple or it can be very complicated. And let me tell you, if you find that it's very complicated, should you be buying it? Probably not. Because remember, it goes back to that balance, analytical with the story. If the story is too complicated, why do you care? Right? You should be buying things that you're like, I get that business and I can value that business. I know that business is undervalued. So you have to have both in place. So yeah, like there's no fixed process. With Gencor, I found it that it was weirdly cheap. And then my brain goes, it's a thought process. My brain goes, Why is it so cheap? I always think, and this is kind of maybe something that people can take as a checklist, look for shareholder lawsuits that could give you an idea. Look for something to do with the management team. Maybe the management team in the past has done some things, right? I won't say that, like, I will never say that in a video, by the way, because as a creator or anyone in the future, never post it on the internet or something like that. Don't say something, because even then they can still sue you. All right, lawsuits can still be a thing. But
wait, you mean that don't sue me, bro? This doesn't work.
No, it doesn't work.
Oh, okay.
No, you can sue someone for anything if you have the capital to do it. And of course, you got to be careful that the other person has the capital not to like go back. But yeah, someone could sue someone for everything. There are some states that are that they're called slapback lawsuits or something where you. But anyway, I think Florida is one. So good on Florida. So don't quote me on that. I'm not a legal expert, so I don't know if Florida is one or not.
Don't sue me, bro.
Don't sue me, bro. Yeah, you see right there. We have to try. We have to try. Otherwise, it's hard to say a lot of things, right? If you're always worried about that. But like, let's say, give me a random stock. Hopefully, I've never heard of it before, but we'll see. Random, just doesn't matter if it's profitable, not profitable, bad company, good company.
You probably heard of it, but you know, I'm interested in it. Can you search up C3?
C3 AI? All right, yeah. Cool. Let's go. Yeah. And by the way, this is like a thing that happens over time. So over time, your brain literally will become like a dictionary. You'll know the tickers of almost every company. All right. So down, I'll look at this. Okay. So let's see. What's the market been doing on it? Okay. The market's been trashing it. All right. Is it justified? I really don't know much about this company otherwise than people think it competes with Palantir. And it sort of kind of doesn't. All right. So one thing I sometimes like to look at, and they don't have it here. Maybe they'll have it somewhere else. I'll kind of explore it. All right, let's take a look at the financials. Or maybe it'll show up in profile. And no. Oh, here, found it. This is where it is in Yahoo Finance. Now we know where it is. These are all the people. All right. But I'm going to look up this guy. All right. So this guy is here, and he's the founder, CEO, and chairman. He's making 5.56K. So he's probably getting paid in stock-based compensation, by the way. But he's going to be an interesting lookup. I would want to understand him, his mission, what he's done in the past. Does he have experience? Is he suited to lead this company?
Where do you search that up? Like, do you go to LinkedIn? Do you look at his profile?
You mentioned them all. LinkedIn is a good place. There's probably, if he's famous, literally doing this, going here, going there, enter, boom, just have at it, right? And then the more information, the better, right? There's going to be videos on this guy. This is if you're taking an investment very seriously and you're saying, okay, I really need to know why would I focus on that? Well, if I look back here, look how much power this guy has. Well, he's founder, he's a CEO, and he's a chairman. He basically controls the business. You don't want to know, like, if we're going into business together, you don't want to get to know who I am. Let's say I'm controlling the business. You're just doing your thing where you live. You're doing all the things you normally do, and you're letting me control everything. You don't want to get to know me before you put all your money with me.
Literally somebody's controlling your money.
Yeah, quite literally. So I kind of want to know what this guy does. So I'll go look at that. Then let's say I do that, and now I come over here. All right, so I want to see, all right, they are growing. That's cool. That's a quick look. Okay, so here I'd look at this, make sure if this is growing faster than this, that's a red flag. I look for red flags more than anything. So if this is growing faster than that, red flag. There's all these other metrics, but on an EBITDA, this is otherwise known as
operating. Question. I keep hearing that EBITDA.
What was that?
No, sorry, can you repeat that one more time?
No. What do you say? So you keep hearing EBITDA?
Yeah, EBITDA. What does that exactly mean? What does it stand for? What does it mean?
Okay, EBITDA. It's an acronym for earnings before interest, taxes, depreciation, and amortization. Okay. So
why would that be a better metric or a worse metric than just earning after all that?
Okay, well, I'll say both sides. Some people say it's a better metric because it shows the operations of the business, because taxes and interest expenses aren't technically the operations of a business. Now, if you go for someone like Buffett or Charlie Munger, they'll counter that and they'll say, that's a load of baloney. They use more colorful language because they call it BS earnings. And the reason why is because interest is a real expense. Taxes is a real expense. And technically, depreciation and amortization is technically also a real expense that you want to account for, because you don't think you're going to buy more equipment.
Now, let me get it straight. So it's pretty much like saying this company will be, it's pretty much like saying this company will be better if it was in a country that didn't have taxes or nothing ever went down in value.
Yeah. In some degree. It's isolated.
And then in the real world, that doesn't exist. No. All right. So it's in theory. So it's pretty much like earnings in theory.
Well, there's a reason why it exists. The reason why looking at EBITDA, EV to EBITDA, is a metric. It was created in the 80s to evaluate the acquisition of entire businesses. So in the instance of, let's say I'm looking at buying an entire business, I will actually use EV to EBITDA because when I use EV to EBITDA, I'm eliminating the debt and I'm not including, so therefore no interest. I don't care about interest. I'm eliminating the taxes because the taxes we will pay together when I buy the whole thing. So once I buy the whole thing, their income will be my income and we will pay taxes together. So I don't want to count that as well. So I just want to look at the thing that I am buying. So you use EV to EBITDA. But if you're looking at stocks and you're buying a piece of the stock, it doesn't make as much sense. However, there is an argument to be said for what's called the acquirer's multiple. That's another book you could read to understand that further, the acquirer's multiple. And basically you use metrics like EBIT or EBITDA to come up with what is called, like the name says, the acquirer's multiple, because it goes off of that same philosophical statement I just said in terms of finance. But looking back here, let's go to cash flows real quick. And yeah, they're negative cash flows. So here is
once you're done showing me that, can we go to that section where it says how much management owns of the company?
Yes.
Once we're done with this.
So I'll show the balance sheet first because I think that's also important, but then I'll show that. So yeah, here we see negative cash flow. So the thing with this is I don't know if they're going to be scalable right now. It's going to be a little more difficult. I don't think we'll have time to really go over entirely that, but it'll be a little more difficult to find that out for something like this. So this is already going into the harder bucket. Palantir is easier than this one. This is harder than Palantir to evaluate. Then taking a look at the balance sheet, we can see its survivability. If it load for me. Oh, it's loading. Hold on. If it's not, I'm just go to a different website. Maybe they don't want us to see the balance sheet. It's a conspiracy theory.
Yeah, right. Is that management? Going against it? Right there?
Yeah. Okay. So we can go. Okay, we're here. We're at the balance sheet. All right. Cool. Total assets, total liabilities. All right, it's bigger. I'm guessing they have no debt. Let me go here. Yeah, they don't have any long-term debt, so no debt. And then let's see the cash, current assets, cash and cash equivalents, and other short. So this is bonds. When you see this is typically bonds. Other short-term investments, typically like they have bonds or CDs and stuff like that. So they have about 1 billion in cash. So let me see the size again. Yeah, it's about 1.9. So 1 billion of this value is in cash, but we also have to keep in mind that they have a burn rate. So their cash flows are negative. So they are burning cash and it's increasing. Well, actually, no, it's kind of off. It's increasing, increasing, decreasing, increasing. So that would be something to investigate right there immediately. Boom. I need to investigate that. Why is that happening? Is that a problem?
How would you investigate it? How would you?
So I take a look, for example, here at the operating cash flows. I say, why the heck is this different from that? Well, sorry, this is different from that. So I'll look down here and I'll see for any numbers that are very different. So right here, I see, well, net income is very different. Net income is very negative. It went far more negative in the trailing 12 months than over 2021. And 2021 ended on 4/30/2021.
Wait,
So
let me rephrase it one more time. How would you go from that point? Because obviously we're seeing numbers, right? Where do you go on? All right, because obviously I'm seeing numbers, but how do I find an answer to that number?
it's exactly that. The investigation process is you look through these numbers, find what is causing the difference. If we find the cause, then we can think about it and say, is that a problem going forward? Or is this just something that's happening once this year?
Question. Would I be able to find that out in, like, let's say like a 10K and 10Q?
Yep.
Okay.
Yep.
So that's what I was referring, that maybe that difference will be in those kind of documents, correct?
Yep. Here's kind of a red flag though, because these numbers right here, stock-based compensation, these numbers are adding to this. The fact that this is more negative, but yet the stock-based compensation is going up, tells me that there is something that's even more negative. And I think it's basically answered right here. This is what's causing a big amount of the negativity.
And that line is what? Net
income from continuing operations. So then this is telling me, okay, I have to go here. This is going to be found here on the income statement. So the income statement, net income from continuing operations should be, is that? Yeah, right here. Net income from continuing operations. So now in order to investigate this number, quite literally, we have to investigate up here. What the heck is causing that? So this one, I think is, I wish they could show the full name. I think that's common stockholders. So you see how this one is basically the same as this? It is the same as this. So we can just look above this. So all of these numbers is what we would actually look at. So taxes, probably not that. We look at the pre-tax income. It's basically the same. So we look above that. Investigating here, other income expense. So they had a positive here, but a negative here. Not enough to make this difference though. It's not enough. They did grow this. This also grew. Gross profit is going up actually. So that's not it. Operating expenses. This is it right here. Found it. This is about $100 million difference.
Yeah, which is pretty much what it is.
So now I look into here to look further. Okay. Selling. Okay, so this one's different. Selling and marketing right here. So that's a big expense. That's more likely what's causing a big part of the difference. And this one's also decent enough. So, well, actually, no, that's the total. So this is actually the right here and right here. So now we answered a question. Research and development is one of them. And selling and marketing expense is another one. Are these necessarily bad expenses?
I mean, all depends on the company. It all depends. Now, question for you. All right, so I'm new. I see that number, big number. I get freaked out because, I don't know. I think of it. I compare that to my life, blah, 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 blah. How do I know how much time they have? If they don't raise a single cent, if they keep burning this rate, how much are they going to survive? How would I be able to calculate that or figure that out?
Okay, so well, that depends on how much money they can raise at the end of the day. But a quick way of figuring out now and pretend that they're not going to raise any more money.
Yes.
You go to the balance sheet. You see how much cash they have. Quite literally, this is a dirty way of doing it. This is not technically accurate, but you look at the cash burn, and then you divide. So you say, how many times does this number go into this number?
Yeah.
And again, that's a very dirty way.
Yes.
You go to current assets, by the way. Very dirty way of calculating that. Because here's the things that's missing. Could they raise more money? Yes. They could. They could dilute you more. They could issue more debt. They don't even have any debt yet, but they could issue debt and they could survive that way. But what will the damage be to you is what you have to think about. So yeah, in that sense, be careful. But if it starts to get more too complicated, why buy? Just don't buy it.
Got it. So if I can make a recommendation, if it's possible, can you make a video about this?
C3 AI?
Yeah, a deep, like go deep into it.
Okay.
I would just like to get your point of view. But let's see. Something else that I have in my mind.
I'll have to make this one the last one because then I have to go.
Yeah, no, yeah, for sure. All right, well, you know what? Let's just wrap it up right now. Let me ask you two questions.
Yeah.
First of all, if you could go back in time, what would you advise yourself from when you were like 18 19, whatever?
Well, that's easy. I would have told myself, don't don't go into a biomed, because that was my original field of study in university. It was biomedical scientist, and I figured I even went to paramedic school and all that, and and I was like, you know what, I don't want to become a doctor. And this was close to the end of it too. And then I switched over to accounting and finance. So I go back and be like, yeah, you're gonna learn a lot of cool stuff, I guess, but you're gonna go do this. You'll save way more time. But then you could also say, like, I needed that and I gained still a lot of knowledge. That knowledge will never be taken away from me. I still could go back to university and probably just finish those last couple classes and have another degree, but not worth my time, to be honest. And another thing is, I mean, I kind of was lucky because I started being frugal for the most part pretty early on. So I wouldn't tell myself that. And I did still enjoy myself too. It's not like I only stayed at home and saved everything and stuff. I think I was a decent balance looking back. I'd say, and then we're talking strictly like career stuff, right? Yeah.
No, or just in general, anything that you want to tell yourself. It doesn't have to be career.
No, I'd probably tell myself to relax. I think I was a little too stressed.
Okay. Now,
relax. But obviously, if your future self comes, from a time machine and says, "Hey," obviously they're going to say, "Relax. It's okay."
Yeah, everything worked out.
Yeah.
Now, final thing for you, because I know you're busy, and hey, me and everybody's watching this. Just want to talk for everybody. We appreciate your time, because I know it's a lot, and it definitely takes a certain kind of person to teach people. So appreciate it.
Well, I enjoyed the conversation, by the way, both off camera and on camera.
Thank you. Now, final thing. What is your biggest advice for anybody that's getting into a market? That pretty much, what would be your advice to me or somebody like me that they're still a little confused about they got interest in what you showed right now, but they're still a little confused between going to the balance sheet or going here and seeing this and seeing that. What would be your best advice?
You have time to learn. You have plenty of time to learn. If someone wants involvement in the market, there is a time and a place where you should get involved. But like, let's say if you want to get involved in the market, you don't have to. This is not talking to you specifically, by the way. This is for everyone in general. You don't have to learn all these things. There is a strategy available to you. It's preached by a bunch of people. It's called index fund investing. That would be the way in which someone who doesn't want to deal with this, doesn't want to have the time, and just does that. But if you want to go out and pick individual companies, it will take time, and you have to be patient with it, and you have to just keep going with it. For example, some people do a dual strategy approach. There's nothing stopping someone from saying, I'm going to do most in index funds, and I'm going to learn while I'm having exposure to the market. I'm going to learn while that's happening. And then this is probably the most important part of advice. Honesty with oneself is the most important thing, because the only one you're going to hurt if you're not honest with yourself is you. You won't hurt me. You won't hurt the guy next to you. You're just going to hurt you. So honest with yourself as to when you are ready. When will you be ready? No one will really know. There's no definitive marker, right? I wish I could say, you got to get this license and you'll be ready. There really isn't that. It's really a personal journey everyone's going to take. But I think everyone kind of knows, if we're honest with ourselves, knows when it is we are ready to make a judgment. By the way, that doesn't mean some businesses you're not going to understand any business. No, some businesses are legitimately easier to understand than others. They are. You gave me C3AI. I'm telling you that's going to be, when I do a deep dive, that's going to be a harder business. There are way easier businesses out there that will make a lot of money as well. Okay. In fact, you know what one of the highest returning stocks in the history of the stock market is? I'll leave you off with this. A cigarette company. Yeah, a cigarette company.
Wow.
You would think Amazon. No, a cigarette company.
Yeah, I can see why.
Yeah. Awesome. If you had just reinvested the dividends, I'll say the name, Altria. Altria is one of the highest returning stocks of all time. It's a cigarette company. You just grabbed it, reinvested the dividends, and never touched it. I think the amount of like $1, I think, don't quote me on this, but I'm pretty sure the number was like $7 or $8 million, $1 in like 2017 or something.
Wow.
I could be off by maybe a couple million, but it's in the millions. So yeah, sometimes in the easier understand companies, they can still make a lot of money. And it goes back to, again, I'm quoting him because everyone knows him, Buffett. You don't have to swing at everything. This is, again, a general concept.
Tell me if maybe I'm putting words in your mouth, but pretty much you're saying don't bite more than you can chew.
Yes.
Take it easy.
Yeah, that's another way of doing it.
Time.
Yeah, one step at a time. There's no rush too. Everyone will have their moment. Be patient. Patience is really important in the market. It's actually one of the harder ones to learn. Patience is very difficult to learn. I think we talked about a little bit about this off camera about wanting to be involved, but then, you know, it's important to take it easy. Don't make a rash decision. You know, the time will come and you'll know when you're ready, if you're honest with yourself. And if, you know, if you do everything right in your life, you will be ready. So, yeah.
All right. Well, hey, Fabio, thank you for everything. Appreciate it, brother.
No worries. It was great talking to you and then great to meet you, actually. All right, guys, on that note, I'll leave you guys off. By the way, everyone, it's not that I'm going to do this with everyone. This is, he was, again, one of the first to ask. So it was something that I wanted to do, and I got to know a subscriber one-on-one. It was a very nice conversation, both off and on camera. But on that note, guys, I hope to see you guys on the next one, and have a good one.